Most traders think they need a better strategy. Jesse Livermore only needed one number, 20%. 20%. The number seems small, insignificant, almost too ordinary to be powerful. But for Livermore, it wasn't just a rule. It was a psychological firewall. A line drawn not on the chart, but inside the mind. He said it plainly. A man must be right at least 20% before he knows he's right at all. And the first time I read that, it felt like a riddle. Why 20%? Why not 5%? Why not 50%? But the deeper I went into his notes, his trades, his mistakes, and his philosophy, the truth revealed itself. Livermore wasn't measuring price. He was measuring conviction. He understood something most traders still ignore. The market gives you tiny clues before it rewards you. And only when the market confirms your idea with real movement, real strength, is your trade worth expanding. Let me tell you something traders hate to admit. Most people scale too early. They pyramid into positions before the market proves anything. They chase potential instead of waiting for confirmation. Their confidence grows faster than their trade does, and that's why they fail. Livermore refused to make that mistake. He learned, the hard way, that adding size before the tape validated his idea wasn't boldness. It was weakness. It was ego disguised as confidence. It was impatience pretending to be intuition, so he built the 20% rule to protect himself from himself, only after a stock moved 20% in his favor. Only after the market proved strength. Only after the trend showed real character. Only then would he add, not because he liked waiting, but because he understood the truth. Modern traders still run from, if you're right, the market will show you. And if it doesn't, get out. When I first understood this rule, it changed everything about how I approached entries, sizing, and risk. Because this rule was not about mathematics, it was about emotional discipline. It forced patience. It punished impulse. It rewarded clarity, and it saved Livermore from dozens of bad trades, while amplifying the ones that would make him legendary. He used to watch his early positions like a hunter watches a wounded animal, quietly, without emotion. No excitement, no attachment, no greed. Just observation. If the stock stalled, he did nothing. If it reversed, he cut it. If it gained just slightly but without conviction, he waited. But if it pushed 20% above his initial entry, if it held strong during market weakness, if it showed behavior, not noise, that was the moment Livermore struck with precision. That was his signal that the market wasn't just drifting, it was choosing a direction. And the man who waited for direction was always the man in control. You see, traders love being right immediately. It makes them feel smart. It feeds the ego. But Livermore didn't care about being right early. He cared about being right sustainably. He didn't want a bounce, he wanted a trend. He didn't want noise, he wanted confirmation, and that 20% gain was his proof. His filter. His shield. His edge. It wasn't the trades he entered that made him wealthy. It was the trades he added to mine with discipline, precision, and emotional control. So let me ask you, when your trade moves in your favor, do you add because you're excited? Or wait because you're disciplined? Comment below. Your answer reveals whether you're trading the chart or your impulses. Wanting to add too early and waiting too long to add. That's the paradox that destroys most traders. Every trader has lived inside that psychological contradiction. You spot a setup. You enter small. The position begins to move your way. A few points. A few percent. Just enough to spark hope. But not enough to build conviction. And suddenly your mind splits into two voices. One says, add now. Get in before it runs. The other whispers, wait. It might reverse. Hope urges you forward. Fear holds you back. Excitement tempts you into premature commitment. Doubt warns you not to trust what you see. This is the inner conflict Livermore watched destroy thousands of traders every year. The war between wanting and waiting. Livermore understood that the market plays a cruel trick on the human brain. When a trade barely moves in your favor, it feels like permission to add. But that's exactly when the market is most deceptive. He once said, a man's desire for quick profits blinds him to the danger of premature commitment. And that line cuts deeper than most people realize, because being early feels smart. It feels brave. It feels profitable in your imagination. But Livermore didn't care how things felt. He cared how things behaved. He learned that a small move in your favor isn't confirmation, it's bait. And markets are masters at baiting the impatient. Think about the paradox. If you add too early, you risk reinforcing a weak idea. If you add too late, you miss the amplification of a strong one. Most traders solve this paradox poorly. They add when they're excited and freeze when they're cautious. They size up when they should observe, and hesitate when they should strike. This isn't a problem with strategy. It's a problem with internal timing. Livermore realized early in his career that the market doesn't test your intelligence. It tests your emotional balance. He learned that your first entry is rarely the dangerous one. It's your second entry, your scaling, that exposes everything inside you, your impatience, your fear, your greed, your ego, he wrote. The greatest losses come from adding to a losing foundation. But here's the twist. Most traders don't lose because they add to losers. They lose because they add to winners before those winners prove themselves. They treat early movement like a promise instead of treating it like a question. Livermore trained himself to operate differently. He didn't ask, "Is my trade working?" He asked, "Has the market proven it deserves more of my capital?" That shift in from self-focus to market focus was everything. He removed emotion from the decision-making equation. He replaced desire with data. He replaced excitement with evidence. And that's what the 20% rule solved. It eliminated the paradox. It ended the war inside him. It became the line where emotion stopped and confirmation began. So let me ask you plainly. Do you add to a position because the market is proving your idea? Or because you want your idea to be right? Comment your truth below, because that single distinction separates the disciplined trader from the impulsive one. The market doesn't trap you with price. It traps you with your own mind. And nowhere is that trap more seductive, more invisible, more destructive than in the moment right after a trade begins to move your way. This is the moment every trader knows your idea is working. The chart looks right. The move begins. You feel smart. You feel validated. But beneath that surface confidence lies something far more dangerous, the craving for certainty. That craving is the core psychological trap. Because the moment your trade shows a little profit, your brain begins rewriting the rules. It stops asking, "Is the trend legitimate?" and starts asking, "How much can I make?" The shift is subtle and fatal. Jesse Livermore warned about this moment more than any other. He said, "A man must not be fooled by the first small profit." That is hope talking, not the tape. Hope, the hidden poison. Not fear, not greed. Hope, the illusion that the market owes you something because you were early. Livermore knew this trap well. Early in his career, he would enter positions that moved 3%, 5%, maybe 7% in his favor, and he would add aggressively. Why? Because he wanted the move to continue. Because he believed he had caught something big. Because the tiny profit made him feel invincible. But time and time again, the market slapped him back to reality. Those early moves reversed. Positions collapsed. Trend signals evaporated. And he found himself holding size he never should have built, because he built it on emotion, not confirmation. Livermore eventually recognized the pattern. Every time he added too early, he wasn't scaling on strength. He was scaling on hope. The psychological trap wasn't the market. It was his belief that a small win made him right. As if the market had blessed him with the first step of a massive trend. As if the early movement was destiny instead of noise. And this mistake cost him more than money. It cost him clarity. When you add too early, your position becomes noisy. Your emotions get entangled with the trade. You stop observing objectively. You start defending the position instead of evaluating it. The trap tightens. Your identity merges with your idea. You stop seeing the market and only see what you want to see. Livermore wrote about this with brutal honesty. When a man waits for the market to confirm, he trades the market. When he trades before confirmation, he trades his own imagination. That line pierced me the first time I read it. Because it exposed the truth. Most traders aren't trading the trend. They're trading their hopes. And that's why the 20% rule existed. It forced Livermore to do something incredibly difficult. To ignore the early dopamine hit of being right. To ignore the seduction of tiny profits. To ignore the fantasy of catching the exact bottom, he designed the rule specifically to protect himself from this trap. Because he knew something we all learned the hard way. The early movement is not the trend, it's the test. The market isn't rewarding you with those early gains. It's studying you, checking your patience, measuring your discipline, probing for weakness. Livermore understood that. He didn't fail the test. He waited for the point at which the market was no longer teasing, but committing. The moment when the move wasn't accidental. It was intentional. That's when he added. That's when he pyramided. That's when the real profits began. So let me ask you, when your trade goes up a little, who are you listening to? The market or your imagination? Comment honestly. Because answering that question is the first step toward escaping this trap forever. The market doesn't reward bravery. It rewards proof. That single sentence sums up everything Jesse Livermore learned about catching big moves and multiplying profits. To him, the 20% rule wasn't just a technique. It was the embodiment of a philosophy. Let the market confirm the truth before you commit more capital. Most traders still get this backward. They treat the market like a battlefield that rewards aggressiveness. But Livermore saw it as a negotiation, a quiet, subtle conversation where the market reveals intention only to those patient enough to wait for it. He used to say, a stock is never too high to buy and never too low to sell. People misquote that line constantly. They think it means you can enter anywhere, that price levels don't matter, that you can just jump into strength or weakness blindly, but that was never his point. What Livermore meant was this. If the market is proving itself, don't let your fear of missing out stop you from acting. If the market is disproving itself, don't let your ego trap you inside a dying idea. He refused to value prices. He valued behavior. To Livermore, the true measure of a trend was not the price it started at, but the consistency with which it refused to be pushed back. A stock that rose 20% wasn't too high. It was finally being honest. It was showing its character. It was proving its strength. That's what the public never understood. Livermore wasn't buying high. He was buying truth. He waited for the tape to reveal which stocks were under accumulation by the strong hands, the insiders, the professionals, the big operators. When a stock rose 20%, held its gains, and moved steadily instead of erratically, that was the tell. That was the moment he began building his real position. He described it with chilling clarity. My first entry was a test. My second was a confirmation. My third was the trade. Those 3 steps, test, confirm, commit, are the backbone of Livermore's pyramiding method and the core of the 20% rule. The test position a small initial stake. No emotion. No attachment. Just observation through involvement. He entered so he could read the tape from the inside, because a trader reads differently when their skin is in the game. If the stock rejected him, he got out. If it behaved well, he watched. The confirmation move, when the position was 20% in profit, that was the market speaking clearly. This trend is real. Not imagination. Not noise. Not hope. Character. This confirmation told Livermore 2 things. The stock had underlying strength. Other operators were likely accumulating, and this is key. He didn't add his full size here. He added intelligently, measured, controlled. The commitment phase, this was where the real money lived. After confirmation, after proof, after endurance through pullbacks, then he layered in size. Then he built the position that would define his fortune. He wrote, "Only when the market has shown its hand should a man show his." Livermore's genius wasn't that he found trends early. It was that he only trusted trends that proved themselves. He didn't bet on potential. He bet on performance. He didn't trust setups. He trusted behavior. And behavior is far more honest than price. That's why his method still works today. Markets evolve. Tools change. Indicators come and go. But human behavior? Human nature? Those are eternal. People will always chase early. They will always hope too soon. They will always size up on noise. And they will always ignore confirmation because it feels expensive. Livermore avoided those traps by obeying one unbreakable rule. If the market agrees with me, it will show me. If it doesn't, I will not force it. That mindset alone separated him from 99% of traders. So I'll ask you something Livermore would ask his students. Do you want to be early? Or do you want to be right? Comment your answer, because your response reveals whether you're trading for excitement or for mastery. In the end, the market doesn't punish the uninformed. It punishes the undisciplined. Every trader thinks they need the perfect entry, the perfect indicator, the perfect prediction. But Livermore never aimed for perfection. He aimed for proof. He aimed for clarity. He aimed for discipline. As we close this journey, I want you to sit with something, a truth that Livermore didn't just write about. He lived through victories, ruin, and rebirth. Big profits are never earned at the beginning of a move. They are earned after the market has revealed its intent. That one idea changes everything. Because when you embrace that truth, you stop acting like a gambler trying to guess the future and start behaving like a professional reading the present. The real power of the 20% rule, it wasn't about numbers, not about percentages, not about some magic formula. It was about protecting the trader from the trader, from impatience, from excitement, from ego, from the intoxicating feeling of, I'm early, I'm smart, I got it. Livermore designed the rule to save himself from his own human impulses, and if a legend like Jesse Livermore needed protection from emotion, what does that say about the rest of us? We aren't fighting the market. We're fighting the way our mind reacts to the market. The 20% rule forces you to ask one question that most traders never dare to confront. Has the market confirmed the story I'm telling myself? Or am I adding to a fantasy? That question is uncomfortable. It kills your ego. It destroys illusions. It demands honesty, and that's exactly why it works. Why most traders never catch big trends? Because they want to be heroes. They want to catch the exact bottom. They want to brag about calling the turn. They want to be right at the beginning instead of wealthy at the end. Livermore didn't care where a move began. He cared where a move proved itself. He cared about persistent strength, continuity, character. Hub wasn't looking for the first sign of life. He was waiting for the birth of a trend. And when that trend proved real, he didn't hesitate. He committed, cold-blooded, focused, disciplined, because by then, the fog had lifted. The tape was honest. The movement had structure. The trend had a pulse. He wasn't guessing anymore. He was following. What this means for you. If you remember nothing else from this film, remember this. You don't get paid for being early. You get paid for being disciplined. Anyone can buy a stock. Anyone can open a chart. Anyone can place a trade, but staying patient while the market reveals the truth, holding back your urge to add too soon, waiting for confirmation even when your ego screams, that's where mastery lives. So let me leave you with a question, one that defines every trader's journey. When the market barely moves in your favor, do you see opportunity? Or do you see a test? Comment your truth below. Not the answer that sounds good, the answer that exposes who you really are as a trader, because the moment you answer honestly is the moment you begin to evolve.